All right, good morning, Finom Group members, traders, and investors. Welcome to our latest weekly macro market video. We are going to get at the objective topic of earnings and how they impact markets, market performance. With that in mind, I wanted to start off this week's video with a clip from Morgan Stanley's chief equity strategist, Mike Wilson. Many of you may be familiar with his works. I've been tracking Mike Wilson for probably the last 6 years. I am a subscriber to Morgan Stanley's research. I'm a subscriber to JP Morgan's research, Goldman Sachs's research. As I often say, profess, and espouse to, I believe that investors need to be resourced, not just have one resource, but a multitude, so there can be comparative analysis within your due diligence process. Having said that, Mike Wilson, he leans bearish, not sometimes, but always. I can say that because I know the man's work. I've been following him for years. So it just is what it is. There are perma bears, there are perma bulls. I'm not saying one is right or one is wrong. I'm saying collect the information, absorb it, and study it for yourself over time. See how you surmise the individual strategists from the different money market banks and institutions. With that being said, this was last week's video clip from Mike Wilson, and I want you to hear it for yourself as we kick off this week's subject matter on earnings.
Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, April 17th at 11:30 a.m. in New York. So let's get after it. A month ago, when the banking stress first surfaced, my primary takeaway for U.S. equity markets was that it would lead to a credit crunch. Given our already well below consensus outlook for corporate earnings, it simply gave us more confidence in that view. Fast forward to today, and the data suggests a credit crunch has started. More specifically, they show the biggest 2-week decline in lending by banks on record, as they simultaneously sell mortgages and treasuries at a record pace to offset deposit play. In fact, since the Fed began raising rates a year ago, almost $1 trillion in deposits have left the banking system. Throw in the already tight lending standards, and it's no surprise credit growth is shrinking. If that isn't enough, last week, the latest small business survey showed that credit availability had its biggest drop in 20 years, while interest costs are at a 15-year high. There's a passage in Ernest Hemingway's The Sun Also Rises in which a character is asked how he went bankrupt. 2 ways, he answers: gradually, then suddenly. This is a good description of recent bank failures. The losses from long-duration treasury holdings and concentrated deposit risk built up gradually over the past year, and then suddenly accelerated, leading to the surprising failures of 2 large and seemingly safe banks. In hindsight, these failures seem predictable given the speed and magnitude of the Federal Reserve's rate hikes, some regrettable regulatory treatment of bank assets, and concentrated deposits from corporates. Nevertheless, most did not see the failures coming, which begs the question of what other surprises may be coming from the Fed's abrupt monetary policy adjustment. In contrast to what we expected, the S&P 500 and NASDAQ have traded well since these banks stressed.
In contrast to what he had expected. And again, he's not lying. I have his research. I get it every week. This was the latest report. Mike Wilson, Morgan Stanley, April 17th. It comes out every Monday. It's called the weekly warm-up. But the markets have not performed as he would have expected.
Has appeared. However, small caps, banks, and other highly leveraged stocks have traded poorly as the market leadership turned more defensive and in line with our sector and style recommendations. Our contention is that the major averages.
So you can be wrong on the market, but still have a good position. You can guide your clients with good positioning in the appropriate sectors, because indeed the defensive sectors have by and large outperformed over this banking tumult period.
Are hanging around current levels due mostly to their defensive and high quality characteristics. However, that should not necessarily be viewed as a signal that all is well. On the contrary, the gradual deterioration in the growth outlook continues, which means even these large cap indices are at risk of a sudden fall, like those that we have witnessed in the regional banking and small cap indices. The analogy with Hemingway's poetic description of bankruptcy can extend to the earnings growth deterioration observed over the past year. Until now, the decline in earnings estimates for the S&P 500 has been steady and gradual. Since peaking in June of last year, the forward 12-month bottoms-up consensus earnings per share forecast for the S&P 500 has fallen at a rate of approximately 9% per annum, which is not severe enough for equity investors to demand a higher equity risk premium we think they should. Further comforting investors is the consensus earnings forecast that implies first quarter will be the trough rate of change for S&P 500 earnings per share. This is a key buy signal that we would normally embrace if we believed it. Instead, if we are right on our well below consensus earnings forecast, the rate of decline in these estimates should increase materially over the next.
So clearly, Mike Wilson does not believe the first quarter of 2023 will be the trough or the bottom in the year-over-year earnings. As we go forward through the year, Q2 consensus analyst estimates still have earnings falling on a year-over-year basis. So he's not out of step with that. Where he may be seem out of step is his projection for EPS for the full year is about $200 a share. At the low end, $195 a share. Right now, consensus estimate is about $219 a share in earnings on a year-over-year basis, which is flat to up maybe 1%.
Next few months as revenue growth begins to disappoint. To date, most of the disappointment in earnings has been a result of lower profitability, particularly in the technology, consumer goods, and communication services sectors. To those investors cheering the softer than expected inflation data last week, we would say be careful what you wish for. Falling inflation last week, especially for goods, is a sign of waning demand, and inflation is the one thing holding up revenue growth for many businesses. The gradually eroding margins to date have been mostly a function of bloated cost structures. If and when revenues begin to disappoint, that margin degradation can be much more sudden, and that's when the market can suddenly get in front of the earnings decline we are forecasting too. Bottom line, continue to favor companies with stable earnings that are defendable in the deteriorating growth environment we project. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us.
You know what I have to say to Mike Wilson? For those of you who are a fan, Step Brothers, the movie.
Shut your mouth.
I needed someone
Wait,
to
shut your
work
mouth.
it.
Shut your mouth.
I think we've had enough
Shut for
here.
1 second. Shut your mouth.
I needed someone to
Wait, shut your
work
mouth.
it.
Shut your mouth.
That's pretty much what I have to say. Now, don't get me wrong. Like I said earlier, maybe Mike Wilson's right. None of us can predict the future. We have the tools at our disposal to, do the best analysis we possibly can. And that's all Mike Wilson is trying to do. That's what any strategist is trying to do. Take all the information, put it on the table and, see what your outlook is. How do you model going forward? And, we'll see how this year transpires. With that being said, here's our weekly Nifty 9, as I like to call it. Every Monday, we issue this free report of different charts from within our weekly macro market research report, which comes out every Sunday. If you're not subscribed and you don't receive our macro market research report every Sunday, do check it out at finomgroup.com. It's only $14.99 a month. Well worth it. There's a treasure trove of information, statistics, economic data, analysis, quantitative data, so on and so forth. It also gives you my outlook for the week, for the quarter, for the months ahead, the year, so on and so forth. So with that, let's get into our research report excerpts. And here's our first chart. This is a simple chart. It's just the S&P 500, folks, where I have this 330. So this is where we came into the month of April. Closing value 4109. That's where we were coming into this week, 4133, folks. That is a lot of sideways to only slightly higher. What are we up, like a 0.5% here this month? This market has gone nowhere in a hurry, as I like to say. Keep in mind that this has happened with volatility breaking to new 1+ year low. Probably haven't seen the VIX in the 16 since I want to say 2021. I've heard a lot about sell in May and go away. I kind of wanted to address that in this weekend's macro market research report. This table here from LPL Financial, we can see that the last time the sell in May and go away was a negative return, only 0.3%, was in 2015. Going back to 2008, since 2008, here are the negative returns for sell in May period. 2008, of course, 2011, 2015, and last year, 2022. Now, if you know your history, these years, 2008, 11, 15, we'll see about 2022, obviously, but 2008, 11, and 15 were all followed by positive sell in May and go away period. So, there's a pattern. If that pattern comes to fruition in 2023, then basically from May to the end of May to October is the sell in May and go away period. May to October should deliver a positive return. Again, each of the prior 3 sell in May and go away periods, the next year, 2008, we know 2009, that was positive. That was the year that the market rebounded. After 2011, here's 2012, positive sell in May, go away period. Just a 1% return, but a positive return nonetheless. 2015 was a negative, but it was followed by 2016, a positive sell in May and go away period. So 2022, we shall see if it lives up to this more recent pattern in history. Our third excerpt from within our macro market research report, we finished at the 10-day moving average last Friday, almost right to the penny, folks. The S&P 500 finished at its 10-day moving average. This chart here from the Sentiment Trader and excerpt says the S&P 500 closed above its 10-day moving average for 21 consecutive trading days, triggering the second buy signal for the TCTM composite confirmation model component in 7 months. After similar price trend alerts over the last 95 years, it's a pretty decent sample size, if I may say so. Returns, win rates, and Z-scores for the S&P 500 were excellent across medium and long-term time horizons, especially if a signal occurred after a 1-year low, which it has. So this tends to be a pretty darn good buy signal. Last week, I recognized that, and you probably heard this quite a lot lately, is that momentum and breadth are narrowing and fading and narrowing. The New York Stock Exchange McClellan oscillator gives us a good idea of market internal breadth momentum. And what we can see is on Friday of last week, it fell into negative territory. The other thing to note is that it usually doesn't stop here. It usually goes much lower. It usually goes much lower. It usually, right? So, I mean, this isn't the end of the world, but it does tend to signal more market weakness ahead. Getting more oversold conditions. This right here is kind of a neutral condition. So we're looking for more oversold conditions by way of the McClellan oscillator. And that's exactly what has transpired early here this week. While the S&P 500 was up maybe 3 points yesterday, what we did notice is that volume favored declining as opposed to volume was declining yesterday as opposed to advancing. We also had a really weak advanced decline line from the NASDAQ. New highs barely outpaced new lows yesterday. So there was market internal weakness that continued from Friday into this week. It wouldn't surprise me if we got a little bit weaker, but having said that, people who know my tendencies know that I'm a buyer of the dips, given a lot of these technical and quantitative data from the past. Last week, we had kind of a mixed bag of economic data, which has also been very consistent. It's mixed, but it's consistently mixed, the economic data. There's some good economic data reports and some bad ones. Last week's Empire Manufacturing Index, or PMI, Purchasing Manufacturer Index, came in sharply above economists' estimates and back in positive territory for the first time in 5 months. First time in 5 months. What I noted here or highlighted was that new orders, which is a very key, if not the most important sub-index within the Empire State Manufacturing Index, had a sharp tick higher. Almost all of the metrics did, actually. You see this big uptick in shipments, unfilled orders, delivery times, general business conditions. And that may have led folks to believe that the upcoming Philly Fed Manufacturing Index would have a similar type of turnaround, if you will. The other thing I noted was the prices paid, right? With all of this good activity going on within the Empire State Manufacturing Index, that might lead you to believe that prices also went higher, but they didn't. They kept falling. So kind of a win-win situation there, where you have better economic activity, or at least the survey suggests so, but disinflation, a continuation of the disinflationary process. As I mentioned, that tends to, align with other of the regional manufacturing indices, but yeah, unfortunately, it did not. The Philly Fed got even worse. It fell into an area or territory negative reading, whereby usually you're in a recession, or a recession is not too far away. With that in mind, the leading economic index, or LEI, that was also released last week, and that showed a 12th straight month of declines, which is the largest on record, or in the post-World War II era period, without already being in a recession. These gray shaded areas are recessions. The last time we had 12 consecutive months, we were already in a recession here. We were in a recession here in 1980. We were in a recession, of course, in 2008 with the great financial crisis. So we have a bit of an anomaly here, given that the leading economic index is down 12 consecutive months a year, and yet we don't have an official labeling of a recession from the National Bureau of Economic Research, otherwise known as the NBER. All right, now, why is that? Well, the NBER actually, their guide, or their assessment of the economy, is largely driven by the coincident economic indicators, not the leading economic indicators. And this chart right here shows in red, you have the LEI rolling over 12 months in a row, but look at the coincident black line, which is, it hit a new high. So it's very difficult for the National Bureau of Economic Research to label a recession having taken place or in place while the coincident, or CEI, is hitting a new high. And so I say it's often confusing to try and decipher the macro fundamentals or the economic data. Warren Buffett famously says, if I spent all my time worrying about the macro picture, I'd never make any money. These things have a tendency they work themselves out over time. Let the pundits, let the economists do their job. Let the strategists worry about the macro, while Warren Buffett and the smart money just look for value opportunities. Our 7th research report excerpt came from the S&P Global PMI, Purchasing Manufacturers Index. And like the regional Empire Statement, which is the New York PMI, this had a sharp uptick as well. This was surprisingly strong. The Flash PMI Composite, which is services and manufacturing, was at 53.5. In March, 52.3. So at 53.5, it's at an 11-month high. Services, 53.7 from 52.6 is a 12-month high. Manufacturing, 52.8, huge jump from 50.2. This is also an 11-month high. Crazy, right? I mean, all we hear about is the weakening economy, and yet some of these surveys had a monstrous jump in the month of April. Our next research excerpt, 1970. In last week's video, we talked about years where you had a recession, but the market was actually positive that year. 1945, 1949, 1980. My bad. I overlooked 1970. Yes, there was yet another year where we had a recession and the S&P 500 was actually positive. 1970 was a recession year. Positive return. This particular year did have a bear market trough, though. That was kind of the unique situation there. The recession pricing, however, began in November of 1968. 11/29/1968. That's what this table here is showing. Bear and near bear market conditions. 1968, we started the bear market. It ended in May of 1970. So 1970 recession, we did have a bear market, but the bear market ended early in 1970, given the market enough energy whereby it could climb into the end of the year. What this chart shows you is indeed 1968 as a whole was positive, but we started from the all-time highs, the new bear market falling throughout 1969 and into early 1970. Now, when I say 1970 had a positive full-year return, it was not robust. It was less than 1%, but it was a positive year nonetheless during a recession. It's important to point out that whether or not we have a recession is anybody's guess, and there's a lot of folks that spend a lot of time guesstimating whether or not we're going to have a recession. It does not necessarily mean that the market will have a down year. The market and the economy are not the same. They're not pricing, the market is not pricing the economy in real time. It has a tendency to price economic outcomes that lead to earnings outcomes some 6, 9, 12 months out. There's no definitive answer on how long does the market forward discount future earnings. All right, our last excerpt here speaks to that earnings issue. Equities have typically troughed 6 to 9 months before earnings reach their low in past bear markets. This is the zero line. This is the S&P 500 on the top. This is earnings per share on the bottom. And as you can see, the market usually has troughed well before the earnings have troughed. So while Mike Wilson is talking about we don't believe, that the earnings have troughed in the first quarter, maybe not even the second quarter, that doesn't mean the market will not have already troughed. Historically, it has well troughed 6 to 9 months, in advance of the earnings trough. We are 6 months past, the bear market trough. Here at the end of the first quarter, now almost at the end of the first month in the second quarter. We're in that window that suggests the earnings are going to trough soon enough. Here, and it's not Mike Wilson. He's not in the camp by himself. Bank of America, Michael Hartnick, bull and bear indicator jumps to 2.8. Still say fade the S&P 500 at 4,200. Sell the last rate hike, because that's what's being anticipated at the May 3rd meeting, which is next week, that the Fed will have a dovish hike. They will signal officially that this is the pause. Higher unemployment equals higher credit spreads, which are typically associated with poor market performance. This right here from Barclays analyst, strategist. How low can estimates go? With the earnings season set to ramp up significantly over the next couple of weeks, we think forward estimates are due for a reality check. All right, buddy. Wells Fargo, we see a rough mid 2023 for equities, which appear prematurely, we think, to have looked beyond the recession that hasn't even started yet. Again, this is from this Monday. Mike Wilson, Morgan Stanley, falling earnings growth may weigh on U.S. equities, Morgan Stanley strategist says. Now, coming into this earnings season, and this is from Bloomberg, I read everything, folks. Stocks post strong rally into earnings season. And, that's, people say, well, the market's strong, I want to fade it. It's just this contrarian nature that market participants have. And the stronger the market is, the more robust that feeling to fade the rally can be. Within this article that I read from Bloomberg, it essentially hinted at that very thing. This was the strongest pre-earnings, which was defined, I think, like 4 weeks in advance of the official kickoff to earnings season when your big money center banks are reporting. Definitely strongest rally we had since 2009 going into an earnings season. And again, while many people, including Mike Wilson, this was a concern of his going into earnings season, he said that actually elevates the risk because we had such a big move ahead of earnings season. He believed that's just going to lead to a sell-off. Historically, however, this kind of strength going into an earnings season, again, this chart from LPL Financial says the exact opposite. Since 2000, there had been 27 other quarters when the S&P 500 rallied at least 3% 4 weeks before the start of earnings season. As shown above, these outlier returns historically point to continued upside momentum for the index after the kickoff of earnings season, albeit at a more moderate pace. The average and median 7-week forward returns during the reporting period were 1.4% and 3.1% respectively. 7 weeks, after is basically the whole of the earnings period. So no, there's actually no data that suggests strength in the earnings season leads to higher risk and downside during the earnings season. It just doesn't historically work that way. You've heard of the, strength begets strength, momentum begets momentum. I mean, that fits with what this data actually says. The punditry, the bears, they'll reach for anything. They'll grasp at any straws. And I believe that's what Mike Wilson was doing as well in that Bloomberg article. All right, with that being said, I've got some data here I want to show you related to, earnings. What if we do have a down earnings year? What if Mike Wilson's right? It's actually worse than anticipated. Does that mean the S&P 500 has to fall? This chart right here is from JP Morgan. The change in consensus EPS projected in market returns. The change in annual EPS estimates over any particular year going back to 1985. And you can see most of the time analysts are dropping their estimates. That is a lot of red. This is their change in estimates. Does that affect the S&P 500 annual performance? Historically, no. All they're doing is setting a lower bar for corporations to actually jump over. And more often than not, it doesn't matter what these estimates are. The S&P 500 is largely higher on any given year. This chart right here, going back to 1960, these are all the negative EPS years, all the years where earnings were actually down. 1960, 70, there's 14 times going back to 1960. 14 years we've had negative year-over-year earnings growth. S&P 500 years that were positive or higher. 1, 2, 3, 4, 5, 6, 7, 8, 9 of those years, the S&P 500 was higher with negative earnings. So that's 65% of the time the S&P 500 was higher with annual earnings down. There's not a strong correlation between earnings and the S&P 500's 12-month performance. Oh, I know that sounds like heresy, right? Well, the market follows earnings. Over time, it does. But in the short run, not so much. Not so much. And this is, a study from Brian Belsky of BMO. During the 16 profit recession since 1948, the S&P 500 rose 5.9% on average in the 6 months after the second consecutive year-over-year earnings decline, with gains occurring 75% of the time. Right? So what if we don't trough? What if Q1 is not the trough in earnings and it's actually Q2? That would be 2 consecutive quarters of negative EPS declines. Well, historically, the market is higher. What do you want me to tell you? And then largely, again, I can't stress this enough. What do you think last year was pricing? Market is a forward discounting mechanism. Earnings versus the stock market since 1930, folks. This is the percent of the time returns are positive. Okay, so percent of the time when earnings are up year over year, returns are positive 72% of the time. Good results, good earnings, market is largely positive. But here's the funny thing, and you probably have already seen this. When earnings are down year over year, the returns are positive 77% of the time. So it doesn't get any more contrarian than what people think. So when all this stress over earnings, that's usually not what's going to drive the full 12-month performance of the S&P 500. Another similar study here from Strategic Research. Folks, these are years where the earnings growth is down double digits. Very small return in 2015, 1985. And I always fact check this stuff. When I see these charts from the different institutions, I always fact check them. Like I've got it right here. This is earnings growth going all the way back to 1960. 310, 330 climbing, earnings are growing, 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 earnings are up. Big decline here in 1970. What did we just learn about 1970? S&P 500 was higher in 1970 with a double-digit decline in EPS. Folks, earnings are not going to have a strong correlation with a 12-month S&P 500 performance, despite what all of these strategists say. Scott Wren, which is the global market strategist for Wells Fargo, our expectations that the Fed will not cut rates this year is a key reason we believe the economy will slow further and eventually tip into a recession later this year. Given that, we further believe that earnings estimates on the street are too high, even after taking into account recent consensus adjustments to the downside. As a result, we believe the S&P 500 will likely trade in a range with the upper end near current levels and downside support near 3,700 or just below. But here's the thing, and I've pointed this out several times before. We're getting positive revisions to earnings. This chart from Ned Davis Research, positive revisions shifted forward by 12 months, and it has spiked since December or the fourth quarter of last year. The trailing 12-month earnings are what's falling, not go forward earnings. Big distinction here, folks. With that being said, thank you for joining and tuning into this week's video from Finom Group. I'll see you next week, folks.